There you have it. That's the closing bell at the New York Stock Exchange. The Dow fell by about 400 points, ended the day down more than 1%.
The S&P is down by about a half a percentage point, while the NASDAQ stayed relatively flat. Let's bring in Mark Hamrick. He is the senior economic analyst and Washington bureau chief for Bankrate. So, Mark, what's driving the markets today?
Good to see you, David and Debra. Well, the market was little changed and mixed throughout much of the session, a weakening there before the closing bell. I think there were some hawkish comments made by some Federal Reserve officials, meaning they indicated that it's likely that interest rates head higher from here, and I think that's the full expectation among those of us who've been watching and listening very closely to the Fed. At his news conference last week, Chairman Powell indicated that stocks need to go from their current level, essentially neutral, into restrictive territory. Also, a reminder that while we may not have been celebrating the performance of the stock market very much recently, the just completed month of July was the best single month since 2020. So, a little profit taking here, a little caution after a strong month. That's to be expected, I think.
And today, the Labor Department announcing job openings in June fell to its lowest level since September 2021. The July jobs report comes out this Friday. So what are you expecting it to reveal to us about just how things are going in the economy?
Yeah, it's a big week for jobs data, and this is sort of the lead-off hitter. And this is fascinating because in the previous month, the data covering essentially through the end of May, we had 11.3 million job openings, and the number of job openings declined by 605,000 to 10.7 million. Now, that sounds like a big reduction, but that still is a very high level of job openings, even as we hear anecdotally about some companies cutting jobs. And as a reminder, the data that we get every Thursday, new applications for unemployment benefits, they have been trending higher, sort of at the highest level in 8 months, but still historically low. So that so-called JOLTS data, job openings and labor turnover survey, indicates there's still a big mismatch between the number of unemployed in this country, most recently put at 5.9 million, and as you heard, 10.7 million with the openings.
So, Mark, the Federal Reserve Chair Jerome Powell has said it is likely the Fed's going to keep raising interest rates to fight inflation. How would that impact the job market? And you think the Fed's going down the right path?
Well, the Fed has a dual mandate, a maximum employment and stable prices. What is significantly less than stable are prices, and therefore the Fed has a big job to do. They've only, as of last week, gotten interest rates to neutral, and that means that they've just barely taken their foot off the gas pedal. There's still nearly $9 trillion on their balance sheet, which in its own way adds accommodation in the economy by adding money to the economy. And Americans are clearly fed up with inflation. It by far is the number one issue hanging over their heads and draining their pocketbooks. So they really don't have any choice. Now, it's true that interest rates cannot be the only tool and are not the only tool to address the many problems that have created inflation, supply chain disruptions, lockdowns in China among them. But the Fed has this toolbox and it needs to wield that particular hammer, and wield it they will.
Mark Hamrick, we really appreciate your insight. Thank you so much for being here.
Thank you.